The July 4th Independence Day celebrations are started, and the only thing more American than blowing up is a long holiday shopping weekend. And while about 250 years ago we Americans decided we could live without the British, there are some companies we just can't live without. Fortunately, as investors, that means strong sales growth and faster profits on these, the 10 most American stocks according to consumers. Now let's get into our list, but stick around and I'll show you how I found this list and why patriotism pays in stock investing. The 10th most American stock according to consumers, Levi Strauss & Company, ticker LEVI. And this one shouldn't be a surprise, right? Levi has a 170-year history in the United States, from the first store in San Francisco, selling picks and shovels, and yes, even denim clothes to gold rush miners. Levi's practically symbolized America in the 80s, and at one point were worth a month's wages in Soviet Russia. Now, Levi the stock, though, not doing so well, with an annualized loss of 3.5% over the past 5 years. The company is still a commanding brand in 110 countries with tens of thousands of locations, but revenue has grown at just 2.3% a year over the last 3. Now that is about average revenue growth for a mature apparel company, but it's had to deal with operating expenses that have jumped 4.5% a year, so really getting hit in that inflation on costs and wages. Now, Levi has been able to increase earnings, but by a much lower profitability. Management is targeting 10 to 12% annual shareholder return through 2027, in part on plans to increase revenue by 6% a year, but it seems kind of a stretch goal to me. Still, the shares aren't expensive here at 11.6 times on a price-to-earnings basis, and you get that 3.4% dividend while you wait on that stock to head higher. It's not in my top 5 favorite stocks on the list, but could work for a value investor looking for a stable investment. Ninth on our list of American brands, Coors and the Molson Coors Beverage Company, ticker TAP. Now this survey was actually well before the Bud Light campaign with Dylan Mulvaney and the backlash it's received. Shares of Coors have jumped 30% since the April 1st campaign, and the only question left is, can the company hold on to all those new customers? Molson Coors is the 5th largest beer company in the world, with over $10 billion in annual sales and 15 brands beyond that iconic silver bullet. From seltzers to lemonades and whiskey, it's got something for everyone. Fundamentals are a little tricky though, and I'm not just saying that because I'm a Jack Daniels man. Total revenue growth over the last 3 years has been just 1.1%. Not annually, but total. And while the company has managed expenses lower to bring those costs down by about 1% a year, that's not much of a boost to profits. Analysts do expect 6% sales growth this year to $11.3 billion on that shift from Bud Light, but longer-term growth is likely less than 2% a year, and the company is going to have to prove it can keep some of those drinkers from returning to. On the plus side, though, even after the jump, shares of Molson Coors are still only priced at 15 times price to this year's expected earnings of $4.44 a share. Now, that's cheaper than the 18 times for shares of Anheuser-Busch and well under the 46 times PE multiple on shares of Boston Beer Company. So a relatively low valuation, a decent 2.44% dividend with Coors here. We're just getting started, but I want to show you how this list of most American stocks was made and why the idea of patriotism and branding is so important. Every year, the Brand Keys company surveys 5,800 consumers from 16 to 65 years of age. They balance that survey by gender, political affiliation, and other demographics to get a true sample of the U.S. consumers to assess nearly 1,200 brands for how patriotic they see them. And believe it, patriotism pays in how a company is perceived. Researchers found that consumer engagement and loyalty was as much as 6 times higher in brands people associated with patriotic companies. And it is the loyalty that brands get from that association that pays off in lower customer acquisition costs and profit growth, and that's something you want to pay attention to as an investor. Our 8th most American brand is only a surprise because it's not higher up on the list. Apple Inc., ticker AAPL. Apple has revolutionized consumer tech, from its desktop computer to laptops and the iPhone, and now it wants to do the same thing in virtual reality. And besides that strength as a patriotic brand, Apple was one of only 2 companies to show up in our most loved brand for all 3 generations, Millennials, Gen X, and Boomers, in a video published last month. Apple has a brand power that is hard to match with consumers, but one thing you need to understand about this stock is its cyclical nature around big product launches. The chart here shows Apple's stock price through each iPhone launch, from the first all the way through iPhone 7, and you can see the lead up and through some of those is spectacular. But in years where there isn't much excitement around those upgrades, the stock can fall bad. It's part of the reason UBS analysts have recently downgraded shares to neutral and a price target of $180 per share. iPhone sales barely budged, up just 1.5% in the most recent quarter from last year and expected down 2% this quarter. And you see that sales weakness in every region in this chart. There really just isn't much excitement around this year's products, and the newly announced headset won't hit the market until next year. A 48% run in the stock so far this year has taken valuation to 30 times this year's expected earnings, so it's not cheap here even with that pessimism around sales. Even as an Android user, I can appreciate the unstoppable brand power this company has, but I'd wait for a better price, maybe even as low as $150 a share before I start looking at this stock. The seventh most American brand, Ford Motor, ticker F, is another one that continuously shows up in our branding lists. Ford was also on the list for most loved brands by both millennials and Gen X, and the F-150 has been America's best-selling vehicle for 41 years. Of course, Tesla is still the runaway leader in EV cars, but Ford took second place with 61,500 cars last year, and the fact that Tesla didn't make this list or our most loved brands list leads me to believe that Ford can grab a big share of that booming market. The company has maintained its target for 150,000 F-150 Lightnings and 200,000 Mustang Mach-E's this year. That would be triple last year's production of the F-150. So combine that love for the brand with sales of even a fraction of that emerging EV market, and I think shares of Ford are terrifically undervalued here. Sales are expected 7% higher this year to $160 billion, and the stock trades for just 8 times on a price-to-earnings basis. It might take a year or two, but this one is going to spike when Ford can prove that it can take some of that EV share from Tesla, and you get a 4% dividend to wait for that to happen. We'll get right back to our list, but if you're just getting started investing and need help opening an investing account, I created a quick start guide to opening an account and buying your first stock on 2 free investing platforms. I'll walk you step by step through getting started the right way. It's one of the 3 quick start guides I'll link to in the description below, along with how to analyze a stock and how to create a customized investing plan. They're all totally free, just something to get you started and get that first quick win. So look for those links below. Our 6th most American brand, American Express, ticker AXP. This was interesting because I haven't seen it on other branding lists, but I guess for patriotic brands, it has American in the name, so duh. Even though Amex has more financial services business, it will always be compared to credit card competitors and actually has done pretty well. Here we see in the last 5 years, AXP in green with a 74% return has underperformed the 88% gain on shares of MasterCard, but has outperformed the 66% run in Visa. And the company is expected to post earnings growth of 13% this year to $11.16 a share, which might be kind of a stretch considering a weakening consumer and a history of just 7% annual growth over the last 3 years, but this stock does have the valuation going for it. On a price-to-earnings basis, American Express trades for just 15.6 times that PE ratio. That's versus 28 times for Visa and 30 times on shares of MasterCard. So American Express clearly the less expensive in the card space. One investor who definitely loves the Amex brand is Warren Buffett. Although the Berkshire portfolio holds all 3 major card companies, its $1.5 and $1.8 billion investments in MasterCard and Visa are dwarfed by a $26 billion investment in AXP. It's his 4th largest holding and gives him a full 20% of the company. Halfway through our list, and the 5th most American stock is the Coca-Cola Company, ticker KO. And Coke is another Buffett favorite. In fact, Warren loves Coca-Cola almost as much as American Express. Those crazy nonagenarians love their colas. The Berkshire portfolio owns $24 billion in shares of Coca-Cola, almost 10% control of the company. Now, I've actually come out on the channel before and said I like the better snack diversification in shares of Pepsi, but Coke's brand is undeniable. And while Pepsi did gain 4 spots from last year's list, it didn't even crack the top 10. Now the valuations are pretty similar here, with shares of Coca-Cola trading for 23 times on that price-to-earnings basis, just under the 25 times multiple on shares of Pepsi. Coke has a little slower growth, with revenue up 4.8% a year over the last 3 versus about 8.6% annual growth at Pepsi, but Coke has also managed its expenses much better and is a more profitable company, plus that higher dividend yield at 3%. With over 4,600 stores in the US alone, it's no wonder Walmart, ticker WMT, makes our list. Walmart made the list of most loved brands for Gen X consumers, though it was edged out by Target for millennials, because if there's anything my generation knows, it's how to save a buck. Walmart's greater reliance on grocery for sales. Here we see the company books 56% of its revenue in that grocer segment. That gives the shares an element of safety when the economy and consumers feel the pinch. So while I've pointed out that the shares of Target are less expensive and expected to get better earnings growth if the economy picks up, I still like Walmart for that stability ahead of a recession. We're coming up on the 3 most American brands, but there were some interesting changes in consumer opinions over the last decade, some that could point to a loss of trust for a few companies. Some of the winners over the last year were Apple and Coca-Cola, rising 6 and 5 levels in that survey. While they didn't make the top 10 brands, LL Bean, Nike, and Pepsi all gained 4 spots into the top 50. Another interesting change here was the big drop in news media brands, with MSNBC, Fox News, and The Washington Post all falling by double digits. Founder of Brand Keys, Robert Pasikoff, attributes this to an increased political divisiveness really eroding away at how people see media companies on both sides of the aisle. Brands that fell out of the top 50 last year include Campbell's Soup, Tesla, Twitter, and Zoom. But I want to get your input on this. What are your top 3 most American brands? Don't think about it, just the first 3 that come to mind. Let me know in the comments below. What brands do you think symbolize America? We're into the top 3 most American brands with Amazon, ticker AMZN. And besides Apple, Amazon was the only other company to make all 3 generational lists for most beloved brands. Amazon dominates its 2 core markets with nearly 60% of the US e-commerce market, a number that no other company can even come close to matching. Amazon also controls a third of the global market for cloud services, 50% more than the next largest competitor. And this is another stock I think could be very undervalued. I think the market is underestimating shares of Amazon. For a share of Amazon, you're basically paying for that valuation on just the core e-commerce platform and its Amazon Cloud Services, AWS business. But you're also getting all of that Alexa venture investments like AI, voice, and other tech innovations. The company is expected to grow sales by 9% this year and 12% next. That's strong growth when you consider it's on $500 billion in revenue. In fact, for a growth stock, the shares have rarely been cheaper at 2.2 times this year's expected sales. Now, the Walt Disney Company, ticker DIS, came in as the second most American brand, but this was before that fight with DeSantis this year, so I'm wondering how that affects it with consumers. Whatever your view, though, it's hard to deny Disney's competitive advantage in media and entertainment. We've seen others try to tack together content and distribution, from AT&T to Paramount and Warner Brothers, but only Disney has been able to unlock that secret. Between the theme parks, media distribution with Disney Plus and Hulu, studio content through Marvel, Lucasfilm, Pixar, and 20th Century Fox, and its cable distribution with ABC, ESPN, and FX, Disney has that synergy of content and the distribution that no one else has been able to perfect. And that is where I think Disney has that competitive advantage here over those other streaming providers, because it's got that studio business and the other content. You see, one of the biggest worries I have about streaming stocks right now is it's just getting ridiculously expensive to produce all the content. We're seeing it come through in lower profitability on Discovery, Paramount, even Netflix, but Disney, with the movies, the cable studios, it's all able to continuously pump out the new shows that people want to see. Their shares of Disney have given up all their pandemic bump and then some, slumping to a near-decade low. Analysts see solid revenue growth of 7% this year and $3.92 a share in earnings, but a big jump to $5.34 a share next year on a cost-cutting program. The current PE ratio of around 23 times this year earnings is around fair value, but if the company gets anything like that 36% jump in earnings next year, the current stock price would have been a steal. And the number 1 most American brand, another one that shows up in multiple brand lists, auto company Jeep. And here I made a mistake. Jeep placed high in our most loved brands for millennials and Gen X in those videos, but I said you couldn't invest in it because Fiat Chrysler was a private company. What I missed was that Dutch company Stellantis merged with Fiat Chrysler in 2021, so you can invest through shares of STLA. And yes, if you didn't catch the irony here, the brand consumers see as the most patriotic, the most American, is now owned by a foreign company. But as optimistic as I am on shares of Ford, the valuation on Stellantis looks just as attractive. The company has grown revenue by 18% a year over the last 3. Strong growth, though the merger did skew it higher a little. Organic growth is still around 5 or 6%, which is still very good sales growth for a car company. Against this, the shares trade for just 3.5 times on that price-to-earnings basis. That's less than half the price valuation on Ford, and less than even the 5.5 times PE ratio for GM. So you're getting a company with strong growth, a brand consumers love, and a discount of at least 30% compared to its competitors. Get your quick start guide to opening an investing account with the link below, or click on the video to the right for the 4 monthly dividend stocks that will pay you every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.